Thanks, Kevin. Thank you to Marine Money for inviting us onto this panel today. I've got hopefully a diverse set of views across my panel today. Just to start by setting the scene in terms of what we've seen in the lead up to 2025. Generally speaking, 2024 saw fewer prepayments, at least during the second half of the year. We also saw the exit of some players, NIBC selling its portfolio to HCOB, Oaktree exiting its Fleetscape platform. We've heard a lot about Basel IV this morning and the effects that that's going to have on financiers. We've also seen that banks are facing challenges when onboarding new clients, particularly with ever-increasing KYC burdens. Banks are probably having to decide whether to deploy capital now at low margins or leave some dry powder for the right opportunities if and when they arise. After all, it is a long game. We see that ECAs remain hungry for deals and can help to lower bank costs. And ESG remains important, but perhaps we haven't seen quite as many green features in loans as we may have expected to. I guess it's a question, is it really at the top of the list for banks when they're looking at new deals? And then despite the political landscape with the US government, which has China in its sights, it remains the case that competition from the Chinese and Japanese leasing houses still also remains strong. So turning now to our panelists, I'll start with you, Gaurav. How would you say that the reduction in prepayments during 2023 and the early part of 2024 have influenced the liquidity dynamics and the risk of appetite for mainstream banks providing ship finance in 2025?
Thanks, Kavita. So to set the context, I think perhaps sort of good to go back and think about what was causing all those prepayments, right? So there was obviously some very obvious ones. There was a lot of excess cash. Ship owners didn't know what to do with it. They were going to retire a lot of the expensive debt that was sitting on the book. And there was not as many new ships to order. Everybody's sort of been grappling with the whole question on what to order and propulsion and everything else. So we saw that in 23. It seems to have calmed down since then. I think 24 was relatively mild in terms of prepayments. But that was also a function of the fact that there is still a lot of cash in the system and there are not enough assets. So where does that leave banks? Banks are still very much open for business. There is a lot of liquidity in the market. I don't think the mainstream banks are really going to go down the credit curve. So what that just simply means is there's not enough assets out there, and most of the banks are chasing a very small set of the same names. And that's causing a lot of sort of margin compression. So I do think that this is going to continue. I don't think this landscape is going to change drastically. In a summary, plenty of liquidity, plenty of appetite. I know you said there was a discussion on Basel, which I missed, which is one of my favorite topics. But I do think there will be a switch from that. But I think that impact we will see probably over the course of this year and how that plays out for most of the sort of predominantly the European and the American banks.
Thank you. Mickey, turning to you. I mean, we've heard how competitive the space is. What strategy are lenders employing to remain competitive in securing financing opportunities?
Working? Good. Well, thank you to Marine Money for having me on this panel. For Citizens Bank recognized as a mainstream lender in ship finance today. I'll take a small victory lap for the team, and thank you. For our strategy these days, it's asset, owner, and structure. And that means as far as the asset mix that we're focusing on, dry bulk, container, tanker, gas carrier. If you've heard any of my colleagues over the last few years on any of these panels, you're not going to hear very much that's changed for our strategy for that. As far as owner goes, they need to be able to operate the vessel profitably, preferably, to pay us back. And with good asset, good owner, we're going to find the right structure. We can be pretty flexible as far as that goes. From a competition standpoint, I'd say what makes us stand out and what most lenders need to focus on as best they can is being reliable and having certainty of execution. So do what you say you're going to do. Make sure that you're predictable and that if you sign up to do something, you get one chance to get it right. So it takes a long time to build a relationship. It takes a moment to blow it. You last mentioned what that's doing to pricing. And as Gaurav mentioned, the margin compression, it's real. Good day for owners or anybody who's on the other side of it. And it's just part of the business that we're in. Like Gaurav said, we're not going to fly up the risk curve and start doing riskier things. We all have our own masters to report to and things that we can do, things that we can't do. So ultimately that means it's a good market to be a borrower if you have the right platform, the right assets. And we're open for business. We're going to keep doing that.
Thank you. Paul, in a market where owners are spoilt for choice, in a market where owners are spoilt for choice, to what extent has cross-selling become important to the deals that you look at? And how does this approach influence long-term client relationships and profitability?
Thank you. Owners are spoilt for choice today. There's a huge amount of liquidity in the market. That's for sure. But everyone heard the panel before lunch about Basel IV. That's going to be a bit of a game changer. So yesterday we have excess liquidity in the market and everyone's scrambling around trying to win deals. And everything's hugely competitive. But I'm a bit of a doom merchant on Basel IV, to be honest with you. And that's going to lead to a drain in liquidity. So, sport for choice today, but probably not sport for choice tomorrow, the owners. And the way I see shipping finance in its most basic form post-Basel IV is a little bit like everyone sees an RCF today, which is you buy a ticket to the dance. And once you're in the dance, then you've got to start dancing. And I think this is where cross-sell comes in. Without the cross-sell, the returns of banks is going to shrink. And then you're going to find it hard to justify why you're lending in the first place. The cross-sell will be what drives the profit and the return on equity for the bank, and it will keep the allocation of capital coming into that business to provide to the client. So it's, in my opinion, cross-sell is crucial now. What does that mean? For us, cross-sell means advisory, both financial advisory and strategic capital advisory, including M&A, capital markets. It's working closer to the alternative investors. People talk about alternative investors as an alternative to banks, but that doesn't mean banks shouldn't be involved in actually bringing these alternative investors to our clients. So there's so much to do in terms of using our own capital smartly, sourcing smart capital in innovative ways, like hybrid capital instruments for our clients, that actually this cross-sell, it drives the profitability of the business, and it also makes you much, much closer to your clients.
Thank you. Gaurav, also sort of following on from the cross-sell piece, we've obviously seen banks taking on these M&A advisory roles. Has your organisation taken on more of these roles? And if so, what's the strategy behind pivoting to these types of roles? Is it simply for the fees, or is there more to it?
So there is a couple of factors. Taking a little bit on from what Paul said, right? So the obvious answer is that these advisory roles will generate fee income, which every bank likes. I do think that over time, teams have become more specialized, so we do look at a lot of these projects. We think we have the expertise within the team to be able to add that value to our clients. But the game is also changing, right? If you look back a few years ago, balance sheet was a very simple answer, right? A bank could do a shipping loan after shipping loan after shipping loan to the same clients. It was profitable on a standalone basis, so it made sense. Capital requirements are going up. Under Basel IV, the best outcome is that there will be an increase. There is no world in which it is going to stay the same. Margins are compressed. The same balance sheet is not returning the levels that we are used to. And that's where I think the key word really is going to be relationship value. right? What does that relationship mean in its entirety? And again, taking a little bit from what Paul said, we do these, especially in Europe, we do a lot of these corporate RCFs, which are really the pay-to-play facilities. They don't make any money, but you get the ancillary business going back to justify the relationship value. And I think most banks like ourselves are going to start looking at what that overall relationship value means and whether that makes sense. Because again, simply laying out balance sheet is not going to work.
Okay. Mickey, this one's for you. Every transaction requires a lot of thought. We've obviously talked about Basel IV, decarbonisation factors, geopolitical issues. What would you say constitutes a bankable shipping transaction in 2025, and how have evolving regulatory, operational, market risks reshaped the assessment criteria for creditworthiness?
It's an interesting one. There's a lot in that question. I'll try to pick it apart a little bit. I guess at the top you mentioned decarbonisation and Basel IV, and what's happened geopolitically. Let's say Suez Canal is a topic of interest these days. It's the American here, I'll quote Mark Twain, history doesn't repeat itself, but often rhymes. And before there was decarbonisation, we were dealing with desulfurization. Before this fourth I guess we'll say, Basel IV, there was the third one, and Suez Canal's been closed before. We're coming into 2025, it's been 1 year. I think there was a 7-year closure coming into 1975, a little before my time. So these are not new things. They're not going to reshape our approach. Things change every day, and you have to be able to react to it. You stay in the market, you stay the course, you maintain a relationship, you serve the client. It just goes back to, for me, asset, owner, structure. We keep it simple, and maybe Basel IV is hitting some of our colleagues here in Europe harder initially. It just gives me a running start to catch up to Gaurav and Paul, but we're not going to be looking to grow too far, too big, just incrementally.
Paul, just turning to ESG for a bit. So is your organization integrating ESG criteria into its credit approval framework? And is it a necessary feature in order to obtain credit approval? What does it actually mean in terms of the structure, the pricing, and the deal terms?
Well, I've spoken about ESG on many panels, so this will be no different. But we are a Poseidon Principles signatory. We've also have wider climate targets, and we take those seriously. It's a transparency initiative, the Poseidon Principles, and then we have wider climate targets as well. So we have a commitment to meet those. And the only way of meeting climate targets is by changing lending behavior over time. It's by banking the right clients who also have similar targets and commitments to our own, or standards to our own. And it's also, over time, financing those vessels which are going to help our portfolio align. I don't know how else we can align our portfolio. So we take it very, very seriously. And to do that, there are certain controls in place. So we have lending guidelines. They're guidelines, not rules. We have to take a pragmatic approach, not forgetting we have clients, and you can't cherry pick, because again, having a cross-sell strategy, you can't just cherry pick and then hope to get all these lovely side bits of business. So we have to be very pragmatic, but at the same time, we have controls in place which will lead us over time to prioritizing those clients that take transition very seriously, and also the vessels which are alternative fuel, dual fuel, and when we're refinancing existing ships, it'll be those that have a pathway to alignment. So we have those guidelines in place. Is it an actual requirement on every deal? No, it isn't. But we have to, over time, we have the flexibility, but over time we're expected to align our portfolio. So the torch is on. In terms of what we end up seeing as a result is our deals are structured in a way, or where we are leading those deals. We structure our deals where possible with the right terms, which will set KPIs for our clients, And so we're all incentivized to achieve the same goal.
And do you think, are you seeing enough progress from your perspective in terms of whether deals are increasingly meeting ESG criteria year on year, or is it too early to say at this stage, given we're sort of in the early stages of this, the trajectory on this?
Yeah, we're 5 years in terms of the Poseidon Principles, and we're beginning to see trends now. That's for sure. So things are developing, but it's still early. But it's too late for banks to say that it's too early to change lending behaviour. We should all be now addressing this and realising that our portfolios aren't going to change, aren't going to improve, unless we build climate initiatives into our strategy. So I'd say it's definitely changing. I can really only talk for my own bank. We certainly have a business model and a strategy which is heavily targeting the more sustainable transaction. And I'd be very surprised if other banks weren't looking at it very closely as well.
Thanks. Mickey, many think about new technology and different fuel choices when we talk about ESG, but there is a school of thought that advocates extending the life of existing ships and doing major retrofits. That obviously requires more certainty around fuel choice and banks to continue financing older vessels. With the age of a vessel increasingly becoming a key factor in financing decisions, do you think this is realistic to achieve? And are we any further forward on this in 2025 when we compare to where we were in the previous few years?
Another really good question. And I'd say I can draw a little bit from my career past. Before I got into the finance side in this industry, I was working as a fuel oil trader, and I watched all the different regulations come in for sulfur and also new fuel and what's it going to be and how are we going to address it. Do we build a new ship? Do we convert our existing ship? Can we convert our existing ship? So now sitting here as a financier in this space and dealing with these big capital questions, how are we going to repay this? Can we get the capital for it? I first start with a simple question for, is it technically possible to do these conversions? And even if you click the drop-down menu, conversion to what? So people are converting to LNG as a fuel on existing vessels, methanol as a fuel, some who have their cargoes that they already carry that could be burned, whether it's a navigator, Gary mentioned earlier, they have ethane that can be used as a fuel. So there's a lot of options depending on your own circumstances, your fleet, your assets. Technically, you have to also add things to your ship that weren't there before, that weren't thought about before. Today there's dual fuel ready, and that means a lot of different things. And it could be anything from having an extra letter on the notation of the ship certificate to having piping in place and additional space, additional deck plates for future tanks. And that cost can be from hundreds of thousands of dollars to $100 million, depending on. So a lot going on there, and that's just kind of in the technical aspect of what you're going to do for a conversion, potentially. Operationally, where you plan to trade the ship. Is it a small ship? Is it a big ship? Is there fuel that you're planning to convert to in those places where those assets trade? If not, will there be fuel? Will the supply chain allow it? Depending on what you're burning in your vessel. LNG, it's still pretty new infrastructure, and it's very infrastructure intense. There are tons of LNG bunkering tanks being bid at shipyards because all the big oil majors are seeing the same problem, that there's just not going to be that supply in place to supply these vessels. LNG carriers, sure, you can burn your own cargo again, but these other assets that have the dual fuel option, and if it's LNG in that case, you have to make sure wherever you're going, there's a gas station, effectively. Commercially, is there a business case to do it? This is before we even talk about financing it with debt. Can the owners make enough money to repay the costs of doing these conversions? If all of those check the yes box, technically it's feasible, operationally it makes sense, commercially there is a business case for it, somebody will be there to finance it. I don't know if it's going to be the traditional lenders, the mainstream banks today. Maybe they'll wait and see. Maybe there's a first mover advantage, but probably a fast follower benefit in that case. but certainly there's capital out there for a good business case. There's a lot of colleagues in the audience here who will sign up for that if you show them that case. The last thing I'd like to say on this point is a few examples. So we can use real world. This is already happening. Matson, an American company, they spent on 3 vessels that they've recently converted to methanol as a fuel. Sorry, let me check that, on LNG conversions for Matson. And mind you, they did this in China. It was $35 million for each of the first 2 ships, $35 million, and they completed the third one, $47 million. These are big numbers, and that's to convert an existing vessel to a new fuel without knowing the rest of that supply chain and how things look over the horizon. So, and a separate one you may have seen, I think Tradewinds covered it, but Maersk Halifax, the 2017 build, 15,000 TEU container vessel. Maersk converted this one to be able to burn methanol. It took 88 days in the yard. There's a lot more time in preparation for it, but that's 3 months your ship's off hire in the yard doing this. They extended the hull by 15 meters. That's a big order when you're talking about a big ship already, to now do all of these technical changes to the construction of the ship. I'm thinking about it also as a former seafarer. When you're out there, there's a lot of tension on the hull, and ships, if they're not properly built, don't last. Now all of a sudden you're cutting it in half crossways, extending it, putting a new section on, putting it back together, all for the lowest bidder who got that deal. So you tell me if you want to be on that ship the first time it goes out. And then the methanol, it's still more expensive than conventional fuel. So the deal that you're taking your ship off hire for 3 months, spending, I don't think they put a number out in the public, somewhere between, say, 5 and 30 million would be the range to do that conversion. And then you don't know that you're going to have a better deal on the fuel that you're putting into the ship. I get it. They're a different animal out there, and they can afford to take these chances and research the field. A lot of owners don't have deep enough pockets or the will or the directive to go and make these changes to their existing fleet, not knowing whether it's going to pay off or not. So I admire and I applaud the efforts that are being made, because we have to do something. We all live on this planet. But there needs to be a business case if you want to attract capital to support those.
Do either of the other 2 panelists want to comment on that? No.
I think Mick probably covered all of decarbonisation, so thank you. But I think just a couple of points to add was, from our perspective as a bank, the way we see it is we have a lot of expertise on the transition side. We want to work with our clients through this journey, right? And there is a simpler way to achieve things, which is to offboard clients who are not aligned, but that's just going to push these clients to go to institutions that are less ambitious with their own climate targets. So from the bank's perspective, and this goes across sectors, including shipping, the idea is to work closely and partner with the clients on this journey to be able to enable some of these clients. It's not a binary yes or no answer. And to just make sure that the adequate investment is there to actually make this transition happen. So that's from a sort of macro way that we look at it as well.
Thank you. Paul, with Basel IV, banks are obviously at different stages in the process and how it impacts them, because it hasn't come in across the board yet. One of the problems is obviously that the mainstream high-quality lenders don't have enough loss-given default data. So the regulators use data from some of the lenders who've lost lots of money, essentially penalizing good lenders for the sins of a few banks, many of whom may have exited the industry. Is it likely that banks will eventually be regulated out of shipping altogether in favor of alternative lenders?
Right. Well, I've probably alluded to some of this already. Basel IV is going to be very penal. So depending on what model the banks end up with, and even though it's technically started, there's a staged introduction. And so some banks are still working out what their model is, whether it'll be the advanced model, the standard model, or something in between. Those that have the standard model are going to struggle because their capital is going to multiply several fold. Unless they can pass the cost on to the client, and shipping banks haven't been particularly good at doing that in the past, they're going to find themselves with a much lower return. And if they don't have the cross-sell and other ways of making that return, of course, their institutions, their management are going to look at whether that's an acceptable return on equity or not. And if it's not, that capital will be given to other businesses within the organisation. So that could lead to banks leaving the market over time. But I don't think the mainstream European shipping banks are likely to leave the market. The banks like to finance the real economy, and there's nothing more real than shipping. And undergoing a transition, and again, banks want to be part of that. So I think it's far more likely that those banks who see themselves as innovative and who may have a higher cost of capital going forwards, they look at ways to partner their clients, as Gaurav was saying, on this journey, and maybe working with other financial sponsors, other alternative capital providers. We don't have to always provide our own balance sheet. Of course, we have to provide our balance sheet because they expect to see a debt come from us, but it hasn't got to only come from us. So I can see more disintermediation, working with financial sponsors, but through the banks. I've forgotten the second question, if there was one.
No, there wasn't one.
Okay, I've answered it. Okay.
Yeah, exactly. Gaurav, just in terms of from your organisation's perspective, do you think the challenges that the industry faces make shipping start to look undesirable, particularly against the backdrop of the low pricing? And are there better places within your organisation where capital can be deployed to make the same or better returns? Or do you think there'll always be a role for the traditional banks in the shipping industry?
I think the challenges are not new. They just take different shapes and forms. And that hasn't stopped us in the last 15 years. So I don't think that's going to change. But to answer your sort of second question, I think, are we competing for capital, right, within the organization? And the answer always is yes. So I think even as a very simplistic example, I just sort of look at us. And as a team, we now do look at transportation, right? So we look at both shipping and aviation. So I have to make the choice in my very sort of small unit as to where I want to allocate what is available to me. And then when you expand that out to the wider organization as a large commercial bank, you're competing with just about everybody in the world. And in the last few months, a lot of the banks I've spoken to have actually been doing this whole transportation. A lot of this aviation, shipping, rail are all being combined into the same teams. So I think that is going to have an impact, because the people who did shipping for a very long time are going to have to sit back like me and think, where am I going to sort of spend my time, energy, capital? And again, we will face that challenge as an organization. So every time we need an approval, it's not just about risk, right? We go in and get these business approvals where you have to justify why you should be doing this deal versus giving money to somebody completely different in a different part of the world in a different industry. And does the return stack up? And that's why, again, going back to what I said earlier about the relationship value that every client brings to the bank.
Thank you. Mickey, turning to you, just a question about the sort of volatility of the shipping industry. Do you think over the long term there are other factors that you think will have a significant impact on the market? And should we expect to see changes in loan and credit terms, things, longer profiles, new structures, special features?
Changes happen every day, and we just kind of react to them, adapt to them. I can't tell you what's going to happen tomorrow or next year. A lot of fluctuation in the horizon, and a range of possibilities have been discussed on all the different panels today. The Trump effect, the second season here, starting earlier this week. I think the one thing that's certain is uncertainty, but also the Houthis haven't stopped firing their missiles. There will be more. So Suez Canal is going to create a lot of headlines this year. Open, closed, who's running the gauntlet, who's going to continue to go around the Cape. For me, that's what I'm looking at. Structure-wise and lending-wise, they'll change in small ways, incremental ways, but we're not reshaping the business or how we approach it.
Paul, I think we've got time for one last question. in the current shipping market, what vessel types and sectors are most attractive from a credit perspective, and why? Are certain vessel types receiving more favourable financing terms based on the market demand or other factors?
I could talk for a long time on that question, but I've got 15 seconds. I think it depends. Every bank likes different things, and the great thing about shipping is that there's lots of different segments. Adam went through them all earlier on, and which ones are doing well, which are not. Most of them are doing well today. From a credit perspective, a lot of banks like quite boring, stable cash flows. We don't like the volatility. We leave that to other people. So anything where we like the corporate, but with a long-term cash flow, with long-term charters, I still think if you're talking generally about the banking market, more hands would go up for that type of business than taking big non-recourse debt facilities, which led to the demise of many banks. So I think from a credit perspective, corporate approach, more agnostic feeling towards which sector it is, but a preference towards having some form of mid to long-term charter. Then if you apply the ESG angle, then you're in a different world. If you want to have alternative fuel vessels, you're pushed more down the container ship route today, because that's where the orders are going in. If you have more longer term views, wanting to apply your advisory skills, of course, you can look at the CO2 market, the ammonia cargo market, the wind farm market, and the many banks, of course, are looking at that because they want to look at their own climate targets and long-term sustainability targets. So it's a bit of a waffly answer, my friend, and I could talk for a lot longer.
Thanks. As you've heard from our panelists, they're very willing to adapt to the changes that the market brings, and that's obviously important. Everyone has to do their bit. But I just want to thank you for a really great discussion. Thanks, everyone.